Good evening, Chairman Bernanke. It is nice to see you again.
Governor Perry, it is nice to see you.
Let's get down to business. Chairman Bernanke, how can you justify the Federal Reserve's actions after the housing bubble burst?
The Fed needed to step in because investors all over the world held billions of the securities.
The Fed's lack of regulation allowed the banking system to get where it is today.
I feel that added to the problem, but I would not put all the blame on the Fed. The Fed did not endorse banks giving out toxic loans.
In 2008, there were more large bank failures than in the Great Depression. How has the Fed tried to fix the financial crisis?
I learned from the Great Depression that during a financial panic banks need to be able to lend freely to prevent bank runs and help bring the market back to more normal activity. In 2008, banks became too big to fail. If the major banks failed, a failed global economy would soon follow.
Toxic loans showed up all over the major banks' balance sheets. Why did banks loan money to people that had no chance of paying it back?
This happened because regulations decreased, resulting in no documentation needed to receive a loan.
What does it mean?
Banks had signs on their windows saying 1% low start rate for first year, stated income, no documentation loans, no down payment, interest-only loans pay interest but no principal back, and debt consolidation.
What does 1% low start rate for first year mean?
It means that people only had to pay an interest rate of 1% for the first year and then it would be subject to change after.
Why would a bank do this?
Banks did this to attract people to take out a loan on a low interest rate that they would then raise the second year.
What does no documentation loans mean?
It means that people could borrow money without providing any evidence that they worked or had a steady income.
Do you mean any person could walk in the street and get a loan?
Yes, people were allowed to borrow money regardless if they had proof that they would be able to repay the loan or not.
That's ridiculous. How much was their down payment then?
There was no down payment required.
So, that means people did not have to have an income or down payment to borrow money.
In theory, yes.
Could the banks set themselves up anymore for failure?
Yes, people were also allowed to consolidate their debt.
What does it mean?
And all other debt could be added on top of the loan.
That's absurd. Why would a person ever take out a loan that they had little to no chance of paying back?
There was a false sense of assurance created. Banks convinced them that housing prices would always go up and they could refinance their loan in order to avoid defaulting.
Does that mean if people defaulted, the banks would go bankrupt?
Yes, it does, but these loans were then packaged in securities and quickly sold off along with the risk to another person.
Does this mean once a loan was sold, the seller no longer carried the risk?
Yes, once the banks sold the packaged loans, they lost the risk. The people who bought them would receive the interest paid by the people who took out the loan.
Why was it popular to buy repackaged loans?
Many of the loans were rated as safe, with a AAA rating.
How is this possible? Weren't many of these mortgage loans crap?
Yes, the loans were crap, but the rating agencies made money based on how many they rated daily. The agencies were not held accountable for the authenticity of the loans and ended up giving out unwarranted safe ratings on many of them.
What happened to the mortgages that the banks kept? Weren't those risky?
Yes, they were equally as bad, but banks bought insurance on them offered by companies like AIG.
How was insurance offered?
AIG was paid a premium for the loans they insured, but in return had to pay if the loans ever defaulted.
How did this catch up with the banks?
People started defaulting, it started a chain reaction. And since AIG insured these loans from many banks and only had capital to cover 1 out of 33 that were unable to pay, causing AIG to become insolvent. Banks also became insolvent because they did not receive the insurance money.
Why did the Fed bother to bail out AIG and not just bail the banks out?
The rescue of AIG prevented even further damage to the global economy and financial system. If AIG went bankrupt, it meant the end for the economy, because they had become intertwined in the banking system.
The Federal Reserve loaned AIG $85 billion without any strings attached.
No, AIG has sizable assets they used as collateral. In fact, AIG is currently stabilized and has paid the Fed back with interest and is in the process of paying back the Treasury.
The Fed securities have increased from $800 billion to $2 trillion during the crisis. How has this affected the economy?
This reduces the supply of securities, increasing the price on the securities while causing the securities to have a lower yield.
The lower yield has hurt investors and people on fixed savings due to the fact they expected returns on investment.
I understand that, but the goal of the Fed has been to keep long-term interest rates low.
With low long-term interest rates, wouldn't you expect people to invest in the housing market?
Yes.
That has not been the case. The crisis is the slowest recovery in history. Recovery in the past has directly been related to the housing market. The decline in housing prices caused new home construction to fall 80%.
The issue is that banks are sitting on their money and not lending.
The extra reserves the Fed has created in the banking system has not stimulated the economy as much as expected.
No, it has been slower than expected.
While the Fed was bailing out financial institutions, what has been the effect on the GDP?
GDP has fallen more than 5% from its peak to its trough.
With GDP fallen, what has happened to the manufacturing output?
It has declined by 20% during the recession.
Unemployment is directly related to the manufacturing industry. Is it also being impacted negatively?
Unemployment has improved, falling from 10% to 8%.
How many jobs have been lost throughout the recession?
8.5 million people lost their jobs.
Is it true that people that have been unemployed for more than 6 months have a harder time finding a job compared to people who have lost their jobs recently?
Yes, a recently unemployed person has a higher chance of finding a job.
This has made the federal budget deficit worse.
Yes, higher unemployment results in a larger federal budget deficit.
It is evident that the economy is underperforming, especially with all of the money the Federal Reserve has created.
It's a slow and long recovery. We have seen a modest improvement.
It's apparent the Federal Reserve has gone for the tortoise and the hare approach.